SpaceX, it's the hottest thing. IPOs are the word of the day. It's all over the media. It's all over your news feed. It's all over social. You can't go anywhere without hearing the word IPO right now or SpaceX. Today, let's break down what SpaceX is and whether or not participating in an IPO is right for you.
All right, grab your favorite mug. It's time for coffee with your retirement coach.
What's in the news today? Elon Musk? IPOs, SpaceX, my gosh, it's everywhere. You turn on your TV, you turn on your devices, Facebook, Instagram, LinkedIn, it's everywhere. Today, we're going to break down what is SpaceX, and we're going to break down whether or not somebody should invest in an IPO. Before we jump in, your coach is behind the clipboard today. I'm Coach Nick, and with me, my partner, my friend, my dad, who likes to say he's my brother, Randy Yeomans.
Hey, Nick.
Hey.
Good to be back.
Yeah, it's good to have you back. Yeah. You went on a little sabbatical.
Well, got stuff to do, man.
Yeah. Were you doing your one thing or what?
I was doing two things. That was the problem. I got lost.
Yeah. Well, you had an adventure, right?
Had another adventure.
Yeah.
Which I recommend to everybody.
Yeah. Well, the running joke in our family is that the older you get, the more of a risk taker you become. And we're waiting to see you on a skateboard, like getting on the X Games or something,
Yeah. I'd rather crash and burn than rust out, I guess.
Yeah, I love it. Well, today we're going to talk about something that is all over the news, right? Yeah. I mean, you can't turn on anything without hearing about SpaceX, the IPO, Elon Musk. Yeah. It's everywhere.
Yeah, and boy, there's a lot of opinions about it, good and bad. And I think, our viewers probably want some real good stewardship ideas about that. What is that a good thing for me to invest in this, this fear of missing out that we hear about?
FOMO, right?
Yeah.
We've got a FOMO culture.
Yeah, and especially with all the hype. The more people talk about it, the more excited folks go. And I think we need to deal with not only what the company is and what it's about, what it could mean, but also when should you invest in a company like that?
Yeah, no, that's great. And for our viewers today, what we're going to do is we're going to start with what is SpaceX? Let's break it down, because it's not like a cookie cutter kind of company that just does one thing. It is really kind of an amazing company. But a lot of people are confused. A lot of people just think about rocket ships. They just think about going to Mars, because that's what you're familiar with. But let's actually break down what the company is. And then, Randy, I know we're going to have a great conversation about, all of the things that somebody might want to consider before they jump into a company and invest in a company like this.
Yeah, it is exciting. And we love helping clients make good investments. But the excitement is not a great tool for making good investment decisions.
Yeah. So excitement's not a plan. That's what I heard.
It's not a good strategy.
All right. Well, as we think about what the company is, SpaceX, it's not really that old of a company. It was founded 24 years ago by Elon Musk. And what I really like to think about is it's got these key components to it. SpaceX has 5 primary business segments. Number one, it has its launch services. So we're all familiar. It's designing, it's building, it's launching rockets. The primary vehicles being the Falcon 9 as an example. Then you've got Starlink, and Starlink really became this common thing many of us were talking about during the Ukrainian-Russian war, as Elon Musk said, hey, we're going to get one of those Starlink satellites so that Ukraine has access to this telecommunication. Then we've got the government defense contracts. So it's a major contractor to NASA, the U.S. Space Force, the NRO, the Department of Defense. I mean, it's generating billions in recurring government revenue just on those government contracts. Then you have human spaceflight. And Randy, I don't know what your stance is on this, but literally they have sent people into orbit. They're the first private company ever to send astronauts to orbit, and I think that's pretty incredible. Then you've got the 5th, which is Starship. It's the largest rocket ever built. It's designed for missions to Mars, lunar missions, and really it encompasses massive satellite deployment. I mean, Randy, this is like major stuff that this company is involved with, and I could kind of understand the hype.
Yeah, I do too. I mean, totally amazed from everything from Tesla to this. I mean, there's a lot of failures along the way, but you talk about risk taking. Elon Musk has rolled the dice many times, and he's really a very unique individual. Not only is he the wealthiest human walking the planet today, but he has really had an incredible track record of thinking outside the proverbial box, doing things that NASA hasn't been able to do and others. So he's a risk taker and he's been rewarded for taking those risks.
Yeah. And I think about, he is really kind of this dynamic personality that seems to be able to hyper focus on just one thing, getting things done in a way that many people have distractions left and right. But his focus is so intense. And I've heard so many interviews with him and people who know him closely, and they talk about his ability to focus in such an extreme way. I mean, regardless of his politics and all of his beliefs, he does have a brilliant mind.
Yeah, I don't know that I would refer to him in those exact terms, but I would say extremely uniquely gifted and confident, even though I think he struggles to communicate sometimes in a way that is receptive to the average person. But, he's admitted he's got some challenges in that area. But I don't think anybody would hire him to be a keynote speaker.
Yeah. Well, that may be up for debate.
You're right.
Hear him fumble through something,
I would
right?
Say, he'd probably be ideal, right?
Yeah.
In terms of filling the room.
Yeah. Oh, for sure, for sure. But Randy, this isn't investment advice today.
Right.
This is for education purposes only for our audience. Okay.
I think that's really good. Whenever anything is really hyped up, we really need to have to step back because investing is so counterintuitive.
Yeah.
That we've got to be careful about getting sucked into, some kind of thing like we talked about earlier, this fear of missing out. And let's look at examples of the past when these IPOs have come out that had great press.
Well, and I know you've done some digging into this, and I was actually kind of surprised at hearing some of those numbers. And this is be your own student. Go look for yourself, research.
Right.
Google is your friend, but it should be trusted as the main thing. But go research for yourself. Randy, this being for education purposes, and you really digging in, I'd really like for you to share some of that information because I do think it's going to paint some color for our audience today as they're thinking about investing in something like SpaceX.
Yeah. Well, first of all, if you're going to look at an IPO, you have to really have the financial means to consider that, regardless of what prices and where they have the entry level, because a lot of times the entry level for something like this might be far higher than what people can do today. So, if you're not ready to pull the trigger on something like this, you really ought to step back and recognize that there may be greater opportunities to own SpaceX than the initial public offering. And so if we want to go into a little bit of detail on that, what that means historically, why investing is so counterintuitive, and why the fear of missing out is such a bad investment strategy.
Yeah. Well, and I think you're bringing up a really great point right now because there's a lot of uniquenesses around this IPO, but one of them I found really kind of interesting. Many IPOs I've looked at over the years, they've had $500,000 or $1 million minimums as an example. I think the last time I looked at this, there was a $10,000 minimum with some of these brokerage houses out there that have access to the IPO, which means the mass retail investors could actually try to get into this. And to me, maybe people are willing to take on more risk because they have an opportunity than what their risk tolerance really, maybe permits.
Yeah, and it would be inappropriate to invest money that you can't lose in something like this. So, sound investment strategies don't go away because something exciting and shiny comes along. You've got to, getting out of debt is one of the best financial tools that anybody can use. There's nothing sexy or fun about that. Building up an emergency reserve so that you've got something, a fail-safe if you lose your job and you don't want to keep your home and things like that. So there are some really fundamental things before somebody should start investing in things that are more speculative than this. And the other thing is history shows that an IPO is not always, that initial offering is not always, and more often than not the best time to buy.
Yeah, yeah. Well, and let's talk about that because many times our audience, myself included, we hear this all the time. We're going to buy the dip,
Yeah.
right? We're going to buy the dip. What the heck is the dip, right?
Right. So, I mean, that makes sense. So let's, if we look back, I mean, the ones that stand out in my mind, like Amazon, Uber, and Facebook, all of those had, big promotional, they're coming out in that. It's kind of funny, the most profitable one of all, Amazon, they can't make any money, they'll never make any money, et cetera. And, the timing of when somebody might invest. And another reason why somebody might not want to start with an IPO is, the smaller investor who they really want to not push themselves to have too much exposure to something that's so speculative. When it's on the market and they can buy shares, they can buy small increments and they can do it dollar cost averaging rather than doing this initial public offering, which could be much more profitable to them than doing the IPO.
Yeah. Well, and Randy, if we were to take, and I think that was a really great point, if we were to break down a company like Facebook or a company like Amazon, what did those companies look like after their IPO?
Right. So Facebook, 2012, I think, I don't remember the month, they come out, the share price dropped within 3 to 6 months by about 50% of the value. So what happened with a lot of people, they bailed. That's another thing about not being sophisticated in what you're doing and buying based on emotion rather than a logical entry place is, had somebody stuck with it and they bought Facebook initially, held on to it, didn't do anything, they would have had to go through about a 53% drop in the share price shortly after they purchased it, which is going to cause some people to do what you shouldn't do, which is sell low.
Right.
Instead of going, well, maybe this is even better because now I can double down. Most people don't do that. But
it hurts too much.
It hurts. So if somebody bought it at the initial price versus the dip, as an example, they'd have about 3 times more profitability today than if they bought it at the initial public offering.
And I think one of the biggest challenges there, Randy, is when is the dip? When's the peak? When's the trough?
Yeah. You don't know if you're at the top or the bottom, right? You really don't know when to do that. And that's why
I just aim for being the top of the bottom. Yeah.
You want to be the cream.
Yeah, that's right.
So, I think, again, this is such basic, but it gets lost. Incrementally purchasing. And you don't know where the bottom is. You don't know where the top is. And what could occur is a tremendous spike in the beginning. More and more investors come in, and then the reality kicks in that the stock's overpriced, and then it drops dramatically. And all of those unsophisticated, wonderful people start to bail instead of buying more. So this is, again, not a suggestion that anybody should buy any of the things that we're talking about. It's purely educational, but perhaps, sequences of purchases rather than trying to time the top or the bottom. But the initial thing I would say, when it came to Facebook as an example, the best time to buy wasn't in the beginning. It was within 3 to 6 months after the initial public offering.
Yeah. So, and I could say that timing matters.
Yeah.
But the problem is to time something so perfectly, almost nobody can do that.
You can't do
right?
it. And people that say they can do it, they're not telling you the truth.
Well, 50% of them are wrong or lying, and they don't know it.
I think, though, the logic is that prices fluctuate. Yeah. So that can either be something that happens to you or something that you do, smart decisions as a result of knowing that what's going to happen is prices are going to fluctuate. It's like somebody says, what do you think of the economy today? What do you think is going to happen over the next year or so? Well, opportunity mixed with difficulty. I mean, that's what the economy always looks like.
Yeah, brilliant.
So take advantage of that.
I mean, I think that is such sage advice for people to really, our audience to really tune in and capture, because we're going to keep having that. I mean, going forward.
It doesn't go away.
It doesn't go away. And the thing is, there's always going to be other conflicts and things that are going to stir us to make good decisions or bad decisions, but many times they're out of emotion, either fear or greed. Right now, I'm seeing a whole lot of greed around this IPO, and I'm not seeing enough intellectually sound reasons for people to come out and actually say, this is why I'm buying this. Here's what I've looked at the fundamentals. I've looked at and I've done all the analysis. I've sought wise counsel.
Yeah.
This is what I'm doing. What I'm seeing more is kind of the social media boom of people getting really excited by, people, these talking heads who are saying, here's why it's so good and blah, 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 blah. But it's you're listening to these people behind a microphone, just like you and I today,
absolutely.
but they're not being their own student to go find out for themselves and do the research and try to find the data to support whether or not they should buy.
Well, this is why I think, again, very self-serving, but good sound advice from somebody who's not vested personally in it and is not trying to please you, make you happy, but it's going to give you that sage advice that you talked about. You look at Uber, which was another one. I think it was 2019. I don't remember exactly. It came out. It lost about 67% of its value. It struggled and struggled and struggled and struggled. But 67% drop, that means, what if you put in $100 or $100,000 or $1 million, what do you have at that dip? Fear, I would say, that this thing's going away. It's not going to make it. It's not going to be a good deal. But if you bought at that dip, and nobody would have bought it at the exact date, I mean, somebody did.
Sure.
The odds of you doing that. But if you bought it at the initial public offering versus at the dip, and you look at where the price is today, you would have 6 times more investment return by buying in the dip than you would if you bought it. And it still was a great return. I think you'd have like a 300% return versus a 600% return or something like that. I mean, it's dramatically different. But again, was that a good investment? Well, not if you bought it and sold at the wrong time. And that's what I'm afraid that a lot of people, when hype happens, they're going to do it wrong. And Sir John Templeton, one of the best known modern investors today, who's passed, obviously, Sir John Templeton, he said something that stuck with me my whole career. The masses are wrong. At least I think I'm crediting it to him.
Yeah. Well, and we could even go, and I'm paraphrasing Warren Buffett, and he says, when people get greedy, I get fearful. When people get fearful, I get greedy, right? I
So
mean,
there is
it's the
a
same.
common theme here.
Yeah.
And that's why, you need a strategy. You don't need anything emotional is a bad idea. Even if it works out. I mean, if you get emotional and you do something and it works, the problem is you could think that that emotion was a good investment decision-making tool, and you'll be wrong 10 more times after that initial one. So it's really putting together a sound strategy.
So in your mind today, what does someone who should consider something like an IPO, and I know should is a dangerous word, but if somebody was to be like a reasonable person that it makes sense for them to approach an IPO, much like SpaceX today, what does that person look like?
Well, Nick, I think for them to consider that, they have to have a net worth to where they're really playing with money that they don't need. This is, if they lost it, they're okay. And because the wins that you have to have, we'll talk about one other element. Let's use an example of Amazon that I mentioned earlier. So I think it came out in 99, and I don't remember exactly when, but I think that dropped almost 95% in value. And everybody was like, this thing's not going to work in that. And obviously, it's one of the more successful firms that have ever existed. Somebody from Amazon's at my house almost every day, or at least an associate firm.
All the shareholders thank you, by the way.
It's just a phenomenal business, but it sure didn't look very good. So the reason I brought that up in answering your question is there is another risk. All these amazing things that Elon Musk has been able to do and other super unbelievable risk takers have been able to do. We always talk about their wins, but a lot of them have had a lot of losses. And one of the losses that you as an investor can have comes from something called firm risk. So if you take Elon Musk, he puts himself out there, and again, I think he's incredible, got an incredible mind. He's unique. I'm just going to call his style of life unique, okay? His quirkiness and that. But, today in an environment like this, if you do something wrong and that filters through to your company, then you innocent shareholders could suffer the results that come from firm risk, meaning one individual company doing something, lawsuits, whatever, losing their major contracts, whatever, that doesn't allow them to sustain the firm. So nobody needs to be taking firm risk. And that's why it's far better to have a diversified portfolio. And then if you want to do something like an IPO, and that what I'm suggesting to you, it might be better to buy it in the market 3 to 6 months after the IPO. Statistically, these big wins, these hyper-focused firms have a big dip, and that might be a better time to purchase it with smaller dollar amounts.
And no one knows, right? I mean, and that's the thing. Like, we can look back at history, and history's a great teacher. It doesn't mean it's going to repeat itself exactly. But I think the other thing to try to convey to our audience today is, regardless of what their belief is about this company, SpaceX,
right.
Here's what's very possible, Randy. And I'm not saying this is going to happen. I'm saying this is a great possibility. Most people who have retirement plans in America today, most people that are buying large cap ETFs at Vanguard today,
I know where you're going.
You're going to end up owning SpaceX.
Yeah, more than likely.
Because if SpaceX does what many people predict it to do, and again, it could fall 95%. We don't know.
Right.
But if it grows and it really becomes this unbelievable growth stock purely by the capitalization of the company, the probability is it's going to end up in the S&P 500 index. It's going to be in the Russell. It's going to be in all these indexes.
And active managers
because
active managers.
These diversified large cap growth mutual funds and ETFs, which are in people's 401ks and their IRAs, their 403bs.
Yeah, that's a great point, Nick.
You could end up owning it.
Yeah, I think you will own it. Like, a lot of people don't realize how much Amazon they own. They don't realize how much Meta they own, or Google they own,
right?
Or, Apple that they own. They have no idea until you do a deep analysis and you find out you may have a 3 to 10% position in some of these companies we just mentioned. And you're right. It's likely, if SpaceX is as successful as people are predicting it could be, they're going to end up owning it through some fund, some ETF, some diversified portfolio. And then you have to think to yourself, is this something you need to do privately? And I'm not against that. And it's just be smart about it. And investing is so counterintuitive. Most people, very smart people, don't do this right because investing is so counterintuitive.
Yeah.
But do you think the money managers out there that are managing a growth fund, or a growth ETF, or whether it's Vanguard, Fidelity, whoever it might be, do you think that they're going to try to look for an opportune time to buy something like this? And absolutely. So what they're going to do, though, is they're likely not going to make a big bet on any one firm, which would be the same advice you and I would give our retail clients. Don't do it. The clients that work with us, which are, the millionaire next door type of client, they've saved well, they want to make smart decisions. They got there by not being greedy, but by maybe taking some risk, but mainly by making smart decisions and living below their means. They don't need to do this.
Yeah.
A matter of fact, I would say, if I think about my really affluent clients and their lifestyle in that, if we doubled the amount of assets that they had, they wouldn't live any different than they do today.
Yeah.
So there's not even a need to do it. So that's why it's exciting. I like talking about this kind of stuff. I think it's a great topic, Nick. But the smart man is going to be diversified and prudent and not take unnecessary risk. And the people who tend to make these risks, I don't mean this to be derogatory, but they're the same people who are betting on the lottery. They're hoping that their ticket's going to come up one day. It's not a great strategy. Being prudent, making good decisions, staying out of debt, saving well, building an emergency reserve, having a diversified portfolio. What you teach clients all the time, having now money and later money. I mean, those are the things that really allow you to go through all the different economic seasons that we're going to face. The market is wrestling right now to break through its resistance, and it's bouncing off support periodically, and that's normal. That's what we're going to see. That's like the change in seasons. And you hear all kinds of talking heads telling you what's coming next. Nobody knows, but you could stay diversified. That's a free lunch. And I think
Man,
this,
I like that.
this
That's
can
strong.
be added to that,
That's
but
strong.
proportionately.
Yeah, no, I think that's strong. And Randy, I love the mindset here because our audience largely is that middle class millionaire, the millionaire next door. And if they made 1,000% or they made 10%, their lifestyle is not going to change. That's not really the thing for them.
Right.
But I tell you what, the FOMO in our society today, the fear of missing out, is real. You know, back right before 2008, the Great Recession happened. I had a client, she was about 78 years old at the time, but very active, very fit, like, a lifetime student kind of person, right? Our kind of people. Okay. And she comes to me and she's letting me know that she's studying for her real estate license. I said, well, I thought that was fantastic. And she came in there to ask for $300,000. Very out of sorts for her. I mean, she lives on her pension or her Social Security, and she was depending on her retirement savings kind of as her, backstop because she's single and, she needed that safety net. I said, I'll call her Cindy. Cindy, that's great. Why do you need the $300,000? And she went on to further explain, well, you can't lose money in real estate. My son and I have been talking, and you just can't lose money in real estate.
They don't make any more dirt, I've heard.
They don't make any more dirt. And so my son and I are going to go into business together. I'm going to give him the $300,000. And what we're going to do is flip properties. He's going to fix up the homes and we're going to flip them. And he's going to let me list the homes once I become a real estate agent. And I'm going to get the commission.
Nice.
I thought, well, Cindy, that sounds like a really great strategy. I said, but here's the challenge. Anything can lose money at any time, right? Nothing is foolproof, but you've got two things, right? You've got when everyone's doing it, it might be too late. When I've got a 78-year-old retired client coming and saying you can't lose money in real estate, maybe it's too late, right? But we went through her personal economics as to why this didn't make sense. Cindy, I support you getting further education. I support you becoming the real estate agent, but I don't think this is wise for you to take this $300,000. And I used all the math to show her. And Cindy agreed that she wouldn't take the money, but she was not happy about it. Right? She
That's
left.
a tough conversation.
Man, her head was down, her demeanor was down, and God, Randy, I felt like crap, because I'm a people pleaser, right? I want people to be happy, but that wasn't the right thing for Cindy. I drove home and I told my wife I felt so horrible. I had to give some bad advice or some good advice, but it wasn't what the client wanted today. It made me feel bad, right?
Well, thank goodness. I mean, but that I want to hear the rest of the story.
All right, Paul Harvey, right? The rest of the story. Well, we know what happened next. 2008, Great Recession, real estate drops. People, they lost their shirt.
She didn't do it.
She didn't do it. Good. Unfortunately, her son lost everything. Okay, so he went and found somebody else to back him. It went away. And a few months passed. I don't know, Randy, maybe 9 months or something like that. I kind of forgot about this conversation and that. And I received a thank you note in the mail.
Wow.
Nic, while I didn't like the advice at the time, thank you for giving me the advice, and I trust you, that kind of thing. Man, I can't tell you how good that did make me feel, right?
We're blessed to be in an industry that we can, if we have integrity, we can offer that kind of sage advice to somebody. And it is hard sometimes. It's hard to tell people that and I'll often in an initial meeting with clients explain to them, you don't want, Burger King. You don't want it just your way. You want prudent advice. And I want permission, if you're going to do something I think is going to harm you, that I can approach you about it. And if you're not listening, I can be ugly about it to the point that, I care enough to risk my, relationship with you, because that's really what you did, especially when you've got another family member involved. Here's what's ironic about that story and what we've been talking about today. Think about if you waited and now it's 2008, 2009, and everybody's home is now worth 50% of what it was worth, exaggerating in some points, but not in others. Literally, the market's dropping.
Buying them from the bank.
And people, the sophisticated and the large institutional investor is gobbling up properties, which we did an episode on even today, to where many, many subdivisions are now basically owned by corporations, and they're basically all rental property. So the time to buy wasn't at the hype of 2018. I mean, it's really interesting.
2008, yeah.
2008,
yeah.
I mean, kind of similar to our story today. The time to buy was after.
Yeah, it was 2009, 2010. I mean, like you said, pennies on the dollar.
Yeah, it was incredible.
Yeah.
It's a great story, and it talks about that. That shares that whole idea of recognizing what season that you're in and how emotions need to be removed from a decision. You did a good job. That's a good story.
Yeah. Well, is that a compliment?
That's the only one you get. This
Well, Randy, I think about it like this. We've got this IPO season upon us. We've got these AI companies looking to list after SpaceX. And I just want the audience today to understand there's always going to be opportunity.
There is. Yep.
And so if that's you, our audience today, you're looking for the opportunity. You don't want to miss out. Our encouragement is to seek wise counsel, get second opinions, and make sure you're doing the right thing for you, not the right thing because you have some talking head saying this is what you should do. If you do want that second opinion, if you want to talk to one of the coaches, our information's in the show notes below. We'd be happy to have a conversation with you. Until next time, thanks for stopping by and thanks for staying coachable.
We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@meritfa.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. Investment advice offered through Merit Financial Group, LLC, a registered investment advisor.